welcome to this exclusive conversation on the expectations from the Budget 2022. The Budget of Hope, as we call it, is powered by Investonomics, an initiative by ICICIdirect. Joining me today is Mr. E.A. Sundaram, CIO Public Markets, O3 Securities, and Mr. Priyank Chandra, Portfolio Manager Public Markets at O3 Securities. Welcome, Mr. Sundaram and Priyank.
Pleasure.
My first question is for Mr. Sundaram. What is that you're expecting from the budget this time, sir? We had an economic survey which says that GDP for FY23 would be 8 to 8.5%. So what is the biggest expectation that you have from the budget this time?
Yeah, thanks for the opportunity. See, the budget, as we see it, is just one of the many economic tools that are available with the government. And we expect that the budget that is going to be presented shortly will be in sync with the general economic policies that have been already announced by the government. So given the fact that the last 2 years have been difficult because of the pandemic and the problems it has created, we think that the budget will try to address this issue to the extent possible. And the most important point we see, which the budget is likely to address, is the job of kickstarting the economy, primarily through physical infrastructure investments, and also try to improve the job situation. We have some alarming statistics on this, and this is a study done by the Center for Economic Data and Analysis of Ashoka University in collaboration with CMIE.
Okay.
And they've estimated that the job losses caused by the COVID pandemic, in the first wave in 2020, about 40 million jobs were lost in urban India, and about 73 million jobs were lost in rural India. These are very significant numbers. And in the second wave in 2021, even though the death toll was more devastating and the hospitalization was far more acute in the second wave, because the lockdowns were not as strictly enforced in the second wave, the job losses were estimated to be about 10 million in urban India and about 12.5 million in rural India. These are very significant numbers. Even though we can conclude that some of these job losses have already been recouped, it is very likely, in our opinion, that the budget is going to place the continuing thrust on job creation, and that they can do primarily through physical infrastructure investments and through the PLI scheme that they have announced. So this is what we expect the tone of the budget to be.
Rightly said, Mr. Sundaram, but what exactly, infrastructure, if we talk about, the investment has already been on the rise, allocation has been on the rise, but the kind of projects, there's a dearth of projects now. So the allocation is high, the money is lying with the government, but there are no projects. So how do they address this?
See, there are procedural delays, no doubt, but let's look at the intent that has been announced so far, and we are going primarily by the report of the National Infrastructure Pipeline report that was generated about a year and a half ago, and also the PLI scheme that was announced by the government. In addition, the government also announced a new scheme called the Gati Shakti scheme, which is planning to integrate the efforts of various ministries and also link the logistics with the manufacturing facilities and so on and so forth. If you look at the National Infrastructure Pipeline report and see it with the kind of allocation that has been planned, it is actually quite interesting. In the 5-year period, 2016 to 2020, India spent about 52 trillion rupees on physical infrastructure. And in the proposed document for the period 2021 to 2025, this figure has risen to about 88 trillion. And what's interesting is that a bulk of this is earmarked for 4 sectors only, which is roadways, railways, energy, and urban infrastructure. It is not surprising because these are projects that can generate large-scale employments. Urban infrastructure, your housing and construction, real estate, your focus on roadway building, railway construction, energy, and all of these things can take a lot of jobs that will support job creation. That is where we think the thrust will come, and it will continue in this budget. The second point was about the PLI schemes. Yes, there have been procedural delays, but that is only to be expected in a country like India, where a little amount of procedural delays is almost inevitable. But let's look at some of the success factors also. about 13 industries have been chosen for the PLI scheme. And this is primarily for two reasons. One is increasing manufacturing activity in this country. And secondly, positioning India as a possible alternative to China for people who want to diversify their manufacturing from one country alone. So you're not going to get all of it, but even if we get a part of it, it's a good thing. So let's look at some success stories here. And the most obvious success story is in mobile phone manufacturing. Until 2005, it's very interesting to know that India did not manufacture any mobile phones. But according to the Ministry of Telecommunications, our production, exports and after sales products of mobile phones is about 11,200 crores in 2019. And it is expected to reach about 8,25,000 crores in 2026. They may not achieve the full number, but there is no doubt at all that the growth is going to be quite humongous in this sector. Now, apart from mobile phone manufacturing, other industries that have been targeted are solar PV modules, electronics, white goods, and also some traditional industries where India has been strong, like textiles or pharmaceuticals or even automobiles and components. So we think that thrust of these two, twin thrusts of physical infrastructure investments and also the PLI, was focused primarily on job creation. That is what we think will happen. As you rightly said, there are procedural delays, but that is only to be expected in a country like India. If there are no procedural delays, we will be surprised. But despite the procedural delays, is development happening? We think it is happening.
Priyank, I read from economics, a strong revival in revenue means that the government has fiscal space to provide additional support if necessary. So what do you make out of this line? And, we have been talking about, increasing consumption. So what is that would really give a boost to the consumption in our country like India?
I'll take that question. It's a multi-year kind of thing. It's not going to be a single year that will determine the growth in consumption. We are bullish on the consumption story in this country, based on some data that has already been established and also based on some assumptions. Let's look at that quite closely. If you see, there are two things here. One is how much is the economy growing by and how much is the population growing by. Both are important to come to this conclusion. If you take the last 3 decades, for instance, in the decade 91 to 2000, India's GDP growth averaged about 5.6% per annum. During this period, the population growth was about 2% per annum. So if you take real GDP growth at 5.6 and population growth at 2%, the per capita real GDP growth per person comes to about 3.5% per annum. Now, in the last 10 years, let's not forget that in the last 10 years, the last year was affected quite severely by the pandemic. And we are going by the World Bank figures and all of these things. In the last 10 years, 2011 to 2020, India grew by 4.99% per annum. And that was affected because in 2020, there was a sharp negative growth. Despite that, we grew at 4.99% per annum. And what's interesting is that the per capita GDP growth, even though the real economic growth was slower compared to 99-2000, the per capita GDP growth was 4.87% in this decade compared to 3.52% in the decade of 91 to 2000. Why did this happen? It happened because the population growth rate has slowed down to 1.1% during this decade compared to 2% in the decade of 91 to 2000. This is a very, very significant number. And now let's come to the assumptions behind our confidence. If we assume that this country is capable of growing at about 6.5% on an average for the next couple of decades, let's say, which is not very difficult because considering the fact that we have achieved 6.5% in the previous 2 decades. And if the population growth rate remains at about 1%, it has a big implication on the per capita economic growth of the country. The per capita economic growth is likely to be about 3 times in the next 20-21 years, which means that the average Indian in the next 20 odd years will be 3 times as rich as the average Indian of today. This is the assumption behind it. And we need not be an economist to see this. We have seen this in our own lives. Just compare, just take the life of an average middle class Indian today and compare the lifestyle of his father's generation or his grandfather's generation. The kind of things that we are buying today and taking for granted today was a big dream 25, 30 years ago.
Yes.
So it's the ability to spend comes with increasing purchasing power, and the willingness to spend comes with increasing information availability through the internet and a multitude of channels and television and so on and so forth. So I think that demand is created by a combination of the ability to spend and the willingness to spend. I think that is a story that will play out in India for the next several decades. So that is why we are confident that the consumption story in India is still very much intact.
Priyank, my next question is for you. I mean, markets are quite volatile. We all know that. What is happening with the portfolio that you're managing? You are sticking to the portfolio, or you are reshuffling it, taking into consideration the change in the reversal in the interest rates that we are not now going to see and the rising inflation?
So our portfolio is mainly running on two things. The first one is a medium-term theme, which is heavily dependent on the infrastructure in the manufacturing development. And second term is a long-term thing, which is you can say, story of a decade or more than that, which is based on consumption thing. So if you ask me that how my portfolio is structured, so I can take you across to the sectors here. So the first sector that I would like to tell you is about the automobiles here. We feel that in case of budget, there can be some announcements which can be done to invest, like you can say, boost the rural economy. Because two-wheeler volumes are heavily dependent on the rural part of India as well as the lower income category. So if there is any, you can say, announcement which increases allocation to the rural schemes, apart from that, is there any tax rate cut, especially in form of standard deduction for the lower strata? So which will definitely give them some additional money to spend. So I think considering the pandemic and everything, people would like to have their own vehicles, and I hope that this will actually spur the two-wheeler volume. Apart from that, if you see the investments in the infra sector is, apart from that, in the first, which is being we are witnessing for the last 2 years, definitely you can say will augur well for the commercial vehicle sector also. The more logistics requirement would be there, more CVs would be required to transport everything. Apart from that, if you see the BS6 implementation, scrappage policy, and the improvement in the road conditions, I think they are a big positive for the overall automobile sector because people will be more confident about that. Over these developments, definitely make them use. Another wish list for the automobile industry can be, you can say, rationalization of some taxes which are there on the import of some auto components. Right. So we believe that infrastructure is likely very much likely to continue. As Mr. Sundaram also pointed out, that government is going to be continuing with the thrust on the capital expenditure. This is one of the key tools to revive the economy. Okay. We feel that the last year the budgeted estimate was rupees 5.5 trillion, and in FY 21-22, and we believe that FY 22-23 would not see any less than a 15 to 20% growth. So we are expecting a budgeted outlay of anything between 6.3 to 6.5 trillion number on a year-on-year basis. Apart from that, if you see, private capital expenditure has been lagging the, you can say, growth as compared to the government expenditure. The reasons have been multifold. The window issue about the clearances, and definitely there are some legal hurdles if somebody wants to bid for it. So I feel that there are some steps which government can announce here, like maybe an extended depreciation benefit for the new projects, single window clearances, and a legal framework for withdrawal options of an existing project going on. So these things will help definitely, you can say, boost up the private capital expenditure selection strong. Apart from that, if there can be any cut in the import duty of the telecom equipment, which have been announced earlier also on a time-to-time basis to support the telecom sector growth, it will make increase the further viability of the existing telecom operators.
The sectors that you are broadly watching is infrastructure, telecom, real estate, and you're expecting some kind of an announcement in the budgets in these sectors.
And something
one last question. I'm just short of time. One last question for Mr. Sundaram. Talking about the government's disinvestment performance in FY22, it has been terrible. How is the disinvestment expected to proceed next year, and how critical can it be to support the fiscal deficit?
The disinvestment is actually helpful, but you cannot predict it. That's the problem. When it will come, because there are too many procedural issues involved in disinvestment. And just look at the track record for the last 8 years. In 2014-15, only 0.51% of the target was met in terms of disinvestment. When you say target, we are assuming that what is given as disinvestment target in the budget estimate is taken as the target. And then we compare it to the actual disinvestment that is done during the next financial year. In the next year, 31% was collected as percentage of target. In 2017-18 and 18-19, the disinvestment was very successful because 100% in 2018 and 106% in 2019 was achieved. Right. After that, it has again started to fall. In the last year, about 1,75,000 crores was set as the target, and until December 2021, only about 9,300 crores have been done. Right. Now, the success of the disinvestment this year depends a great deal on the LIC IPO and also on the BPCL disinvestment. Encouraging sign. So disinvestment, I would treat it as a bonus whenever that happens and not plan anything accordingly.
Thank you, Mr. Sundaram, and thank you, Priyank, for your time. It was a pleasure speaking with you. Thank you so much.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.